Welcome. We're looking at a perfect storm brewing in March of 2026. Today we're going to unpack how a single geopolitical flashpoint is sending these incredible shockwaves through the global economy. It's creating a super volatile environment it's testing investors like never before. Let's dive in.
This is really the central question, isn't it? We've got a hot war in the Middle East that has just slammed into renewed inflationary pressures, and it's all happening at a critical moment for global central banks. The fallout from that collision is exactly what we need to understand.
And here it is. This is the first and most immediate shockwave. Brent crude oil is now trading steadily above $100 a barrel. Now look, this isn't just some headline number you can ignore. It is a direct tax on the global economy. It's fueling inflation, and it's complicating every single policy decision from here on out.
Right, so every major market shift has a trigger, a starting point. And to really get a handle on today's volatility, we have to go back to that initial flashpoint, a military escalation that basically just tore up the map of global stability. Just look at the speed of this thing. In late February 2026, a joint U.S.-Israeli offensive kicks off. By early March, Iran's top leadership is confirmed to be eliminated. And then, just days later, Iran hits back hard, closing the single most important choke point for global oil transit. This incredible speed is absolutely key to understanding the market's panicked reaction.
The fallout was, it was immediate and it was far-reaching. You've got the closure of Hormuz, putting a fifth of the world's oil supply at risk. The conflict gets wider with missile strikes on Tel Aviv. But here's the critical part. The diplomatic front just completely fractured. President Trump's call for support, it was rejected by key allies like Japan and Germany. The move even caused serious dissent within his own administration. So that unified response everyone expected, it never happened.
Okay, so that geopolitical shock, that was just the beginning. The next ripple hit the real economy, and it sent an absolute tsunami through the global commodity markets. The line from geopolitics to prices was just instantaneous. Brent crude soared past $108 a barrel because of Hormuz. Gold spiked to $5,000 an ounce as capital just fled to safety. Even natural gas came under huge pressure after a direct attack on Iranian supply. What we're seeing is a classic supply-side shock playing out in real time. And this commodity surge, it creates the next ripple, landing squarely on the doorstep of the world's central banks. This is their worst-case scenario. It's a policy trap with no easy way out. And the name for that nightmare scenario is, of course, stagflation. It's that toxic combination of soaring inflation, which is being driven by the energy shock, and slowing economic growth, which is being crushed by higher prices and uncertainty. This is the ghost of the 1970s that every single central banker is terrified of.
And you can see the impact right here. It's just staggering. Before the crisis, the market was fully priced for the Fed to start cutting rates sometime in 2026. But the reality now? That hope is completely gone. The first rate cut has been pushed all the way out to April 2027, and that's after the hot producer price index data came in at plus 3.4%, fanned by this energy crisis.
And listen, this hawkish pivot, it isn't just a Fed story. It's happening everywhere. The Fed is holding firm. The ECB over in Europe, they're doing the exact same thing. And the Reserve Bank of Australia has gone even further. They're the first major central bank to actively raise rates in this environment. The coordinated message is crystal clear. Inflation is public enemy number one. So, this brings us to the next ripple. How is the actual money moving? With central banks pinned down and inflation just roaring, investors are being forced into this massive strategic rotation.
And to really understand this rotation, let's look at a fascinating case study, the Italian utility giant Enel. Now, this was supposed to be a safe, defensive play, right? But it very quickly became a trap for a lot of unsuspecting investors.
So what went wrong for Enel? It was just a perfect storm. A regulatory shock in Italy wiped out a key source of their profits, financial strain was building with debt getting higher and higher, and honestly, the valuation was already stretched, so the fundamentals were just deteriorating so rapidly, creating this lethal combination of risks in a stock that was already overvalued.
And Enel wasn't alone. This chart of the Italian market shows the rotation so clearly. Money is just flowing out of these interest rate-sensitive sectors, like utilities and industrials, which are all giving really cautious guidance for the year ahead. So where's it all going? Into sectors like banks, which can actually benefit from higher rates, and luxury, which has the pricing power to survive in an inflationary world.
So all of these ripples, they all lead us to one critical question. How should investors even begin to navigate this new reality? Let's take a look at the new playbook.
This quote from the analysis, it just perfectly captures the challenge. That classic margin of safety that value investors rely on, that buffer between a stock's price and its real intrinsic value, it's been completely vaporized by this crisis. The old rules, they might not apply anymore.
Okay, so the strategic priorities have to shift. First, prioritize real assets, things like energy and infrastructure that can hold their value. Second, execution risk is now everything. You have to scrutinize whether a company can actually deliver on its promises in this environment. And third, be disciplined. As we saw with Enel, knowing when to take your profits off the table and crystallize those gains is absolutely fundamental to preserving your capital.
And this brings us to the final critical question. With the old playbook pretty much obsolete and that traditional margin of safety gone, every single investor now has to answer this for themselves. What is my new edge?